All right, hello and welcome everybody to the weekly market forecast for Monday, July 24th. Some really exciting times in the market right now, so I'm ready to get into this pretty quickly. This webinar is brought to you by OctaFX, the award-winning Forex broker offering some of the lowest spreads in the industry. Let's get going. A couple of quick disclaimers. The risk disclaimer: trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You shouldn't invest money that you can't afford to lose. Hypothetical trading disclaimer: the information in this webinar is provided as general market commentary and doesn't constitute investment advice. In other words, we're not giving away specific trade recommendations in this webinar. Even though this is a technical webinar, always important to be aware of the big fundamental news because that can, of course, shake the market up a lot. So let's take a quick look at the economic highlights this week. Wednesday, we got the UK preliminary gross domestic product quarter over quarter. GDP is one of the most important figures along with employment data and, of course, what's going on with central banks. Wednesday, we've got the Fed news coming out, the FOMC statement, and also the federal funds rate. So we're going to find out what the Fed is going to do with interest rates this month. Most economists are not expecting any change this month. So if there was a change, that would be a big surprise to the market. And then finally on Friday, we got Canada GDP, Canada's gross domestic product month over month. So again, that important GDP figure appearing again for the second time this week. And we also have the advanced GDP number for the United States on Friday. If you look at the calendar, you'll be able to see that. Right, let's get into it, guys. Let's talk about what we're going to cover quickly. As usual, we're going to look at key support and resistance levels, recent and emerging chart patterns, looking backwards and forwards at patterns that are emerging. Technical indicators, we're going to learn about classic technical indicators in this webinar. And we're also going to look at trading strategies, as usual. And every week we have a different trading strategy. And we're about ready to jump in to cover this week's trading strategy. So let's look at the strategy of the day. This strategy is very basic, straightforward, easy to understand strategy, but it's, as you'll see when we look at it on the chart in a minute, it's a rather powerful strategy and contains some interesting ideas. So let's take a look at this 50 EMA break strategy. Okay, so this strategy uses price crossing the 50 EMA, which is the 50-period exponential moving average. Again, don't get confused by these fancy-sounding names. Exponential moving average is just a moving average which puts greater weight on more recent periods. So this strategy uses price crossing the 50-period exponential moving average as an entry signal, and it also has a filter, which is the filter is just looking at what where price is in relation to the 200-period simple moving average. So we'll visualize this on the chart, and it's very easy to understand, very easy to digest. So let's just go through the rules, and then we're going to look at it on the chart, and it'll be very easy to understand. Like all moving average strategies, it works best in trending markets. So yeah, it's always good to be aware of which markets are trending nicely so you can apply these strategies. Finally, for this slide, don't trade this strategy around the release of major news, because of course that can shake things up and totally change the technical picture. So for example, we had the Fed meeting on Wednesday, so this Wednesday it might not be such a good time to trade a strategy like this around when the news of the Fed decision is coming out, but most of the time shouldn't be a problem. Trading rules. In this instance, we're going to look at the pound against the yen, the GEPI. Why? Because it's a very volatile currency and it does tend to trend nicely very often. Time frame we're going to look at is the 1 hour. So what does that mean? Well, it's a relatively short time frame to be looking at, and that kind of tells us usually that we're going to get more signals, but the signals are going to be less reliable than they would be on a longer time frame, like the 4 hour or the daily or even the weekly. So what are the trading rules? How do you know when to get into the market? Okay, so the sell entry, how do you know when to sell? When price crosses and closes below the 50-period exponential moving average, and price is below the 200 period simple moving average, place your sell stop order 2 to 5 pips below the candle that crossed. And below the candle that crossed means below the candle that crossed through the 50 period EMA. Okay, and then conversely, the buy entry, when price crosses and closes above the 50 period exponential moving average and price is above the 200 period simple moving average, you place your buy stop order 2 to 5 pips above the candle that crossed the 50 period EMA. Okay, let's look at stop losses. In the case of the sell signal, set your stop loss order 5 pips above where the 50 EMA is when the cross takes place. That's important because, of course, where the 50 EMA is always changing. So where it is when the cross takes place, that's where you put your stop loss order. In the case of a buy signal, set your stop loss order 5 pips below where the 50 EMA is when the cross takes place. About profit targets, for the 1 hour chart, set your profit target to at least 20 pips. And I want to encourage you to try scaling out of winning trades if possible. So you could do this if, for example, you're trading micro lots or you're trading multiple lots. And it's a good way to lock in your profit and also be able to let your winning trade ride while at the same time booking some profit. And finally, like I say in all the strategies that we cover, awareness of candlestick reversal patterns, momentum oscillators, what's going on with other moving averages, all these things, what's going on different time frames, all these things can further help you measure the strength of the signal. And when you're measuring the strength of the signal, then you can kind of gauge how large an order to place. Okay, so there are the trading rules, and let's make it easy to understand by looking at it on the chart and looking at some instances of trading signals on the hourly chart. So we're going to hop over to the charts now. Okay, so here we are, 50 EMA cross strategy with the 200 period simple moving average as a filter. So how does this work? So your entry signal is you look for the candle where price crosses above or below the 50 period EMA. So we got an example here. Price crossed from above to below, and importantly, it's got to close below it, not just cross, it's got to close below it. Okay, and then your entry is when you put a buy stop 5 pips below the low, if it's coming from to the downside here. And so in this case, you would have put a buy stop order under the market, and you would have got filled here. You would have got filled in this next candle here, and you would have been able to catch this down move here. Okay. Similarly, we've got another instance where price crosses the 50 EMA to the downside. Here it's a nice Maribozu candlestick where it opens at the high, closes at the low. There's no wick. So what do we want to do? We place our sell stop below the low. And here in this next candle, 5 pips below the low, here in this next candle, we would have been filled, and correspondingly, there was a nice down move. Okay, hourly chart, like I said, there's a fair number of signals coming out off of this strategy, right? And it's qualified by, remember, to take a sell, to make a sell trade or take a short trade, price has to be below the 200. So in all these instances, price is below 200, so we're able to take the short trades. Okay, here's a third example. Price crosses the 50 EMA, closes below it. Where's the low? Okay, so our entry would have been here, this next candle, and you could have caught this down move here. Again, crosses from above to below, closes below the 50. 5 pips below it, you enter with a sell stop. If you're not clear what a sell stop order is, I'd encourage you to talk to your broker, and they can explain to you how to enter a stop loss order to enter the market. It's very straightforward. Don't worry. It's just a means of getting into the market at a price above or below where the market is. So again, you would have caught a nice move, a nice down move off of this. So that's 4 good signals that you got off of this strategy. Let's take a look at a bad signal, a false signal, because of course, every strategy is not 100% perfect. And here, of course, we have, right on this chart, we have an instance of where we got a false signal. So here we had price crossing from below the 50-period EMA to above the 50-period EMA, closes above it. So where do you put your buy stop in? Up here. So you would have got filled here, and you would have been had a buy order, you would have been long here. But what happened? Price went right back down, and you would have got stopped out. So that would have been a loser right there. So keep in mind, things you got to remember. You're looking for price to move from above to below, and for price to be below the 200 period, which is this here, to get into a short trade. And then it's the inverse to get into a long trade. You're looking for price to cross from below to above. It's got to close above it, and you've got to be above the 200 period simple moving average. So the rationale with that is that when you're below the 200 period simple moving average, your sell orders are more likely to be successful. And conversely, when price is above the 200 period simple moving average, your long trades or your buy trades are more likely to be successful. So some important basic concepts kind of baked into this strategy. Moving on, let's take a look at the H4 chart. This was our strategy from last week. We used a similar concept where we only wanted to take buy trades above the 200 period SMA and only take sell trades below it. So instead of price crossing through the 50 EMA as a signal, in this instance we had 2 simple moving average crossovers. We were looking for the 10 period SMA to cross the 20 as our entry signal. So for a sell entry, you had to be below the 200, which we were. So here we had a sell entry. We also had a pin bar, which is a bearish reversal pattern, giving a bit more strength to the pattern right there, to the sell signal right there. We had another signal here, another signal here. So we're just below the 200, we're just looking for sell signals. Above it, we're just looking for buy signals. So here, above the 200, we had a buy signal here. Could have caught a little bit of an up move here, and the crossover here could have caught a slight up move there, but not much. So it's a similar strategy, both times using this 200 period simple moving average as a line in the sand. Okay, moving on. We don't have much time. Let's go. We're going to quickly. I talked about trending markets, how moving averages strategies work well in trending markets. So the logical follow-on from that is how do you know what's a good trending market so you can apply these strategies? There are indicators out there which can help you gauge the strength of a trend, like Wells Wilder's ADX indicator. But I think the old-fashioned way of just using your eyes is pretty powerful. So we're looking at silver right here on the daily chart. Talk about a nice downtrend here. We have lower highs, almost exclusively apart from this one, lower lows, a stair-step move down. Again, with this strategy, we were looking at the moving average crossover as an entry. We were using the 5 and the 10 EMAs as our entry signal here, and we were looking as a filter for stochastics to cross from above 80 to below 80 as confirmation. So that would have got you into this stair-step move down here. So I pull this chart up because I think it pays to use your eyes and just scan through all the different charts and look at the ones that are trending well. So you might say to yourself, wow, silver is trending really well on the daily chart. I'm going to look at some moving average strategies, trend catching strategies for that market and that time frame. Okay, moving on to the euro. Exciting stuff for the euro right now. It's seen a lot of strength recently. What happened here? We can see that the euro broke through the resistance level here after the news from Draghi last week. We had that statement from Draghi, which is actually kind of dovish, but the market didn't care, and the bulls just drove it higher anyway. Draghi didn't give away any clues as to the kind of schedule for tapering the 60 billion of quantitative easing that is taking place, but nevertheless, price kept driving higher. So things are looking relatively bullish here in the euro. We broke through this resistance level here. And so the next question is, what's the next resistance above that? And what we could do is take a look, maybe zoom out a little bit. And draw the fib on here. And see if that tells us anything. Well, what does this show us? Looks like price came up almost exactly to the 38% level. It hasn't quite reached it yet, actually, because we're looking at such a big space of time here. I'm showing that it's around 117.25. So I would expect major resistance. We're looking for the next resistance level, since that's so bullish right now, to be around that level of 117.25. Let's delete that and make this bigger again. One more thing I wanted to show you guys on this chart. We talk about trend lines a lot, and trend line patterns, charts, ascending triangles, flags, channels, all this kind of thing. These patterns using trend lines. And a lot of the time, I think beginners think, okay, that's great. I can see the trend lines. I get the concept behind it, but how do I trade it? Like, what's the trade? You know, do I just trade the bounce off the trend line? So here was kind of an interesting strategy that we talked about in a recent week, where we were looking for trades that looked for bounces of a trend line, but it looked at stochastics as a filter, as a secondary indicator. So what you're looking for with this strategy was price to return to the trend line, find support there, but you also wanted to see this bullish signal of the stochastics crossing from below 20 to above 20, with, of course, the line curving upwards. And that's what we saw here. So it was a nice instance of this trend line strategy plus confirmation from stochastics, giving you a nice buy signal, which would have helped you catch some of this up move if you were long, if you had bought. Quick look at gold again here. Had kind of it's had a nice up move recently, but kind of a sideways market since the beginning of the year. Again, we had a similar trade here with the trend line. Price retraced the trend line. Stochastics crossed from below 20 to above 20, so we got that nice bullish signal there. And what happened, it ushered in a nice bullish up move. Dollar CAD, looking at the weekly chart, always good to look at the longer term time frames. Remember that indicators and signals are more powerful the longer the time frame is. So if you're looking at a monthly chart or a weekly chart, these are the most powerful indicators that you have a huge influence. So we're looking at the weekly dollar CAD. We can see that there was a nice channel. Price broke through it to the downside. Nice fluid move down here. And then what do we have down here? We have some nice confluence between the 200 period simple moving average and this major uptrend line here. So we can expect major support in dollar CAD down here. And maybe the market will be shaken up later this week. Maybe price will reach it with the release of the GDP figure, the Canadian GDP figure on Friday. Moving over to the GEPI, our favorite volatile, often nicely trending currency cross. A cross is a currency pair that does not have the US dollar, so this is the pound against the yen. It doesn't have the US dollar, it's a currency cross. Nice ascending triangle pattern. Let's zoom out for a little bit and get a bit of context here. What are we in? We're in kind of a downtrend for at least this portion. Let's pull up the fibs and see what that tells us. Again, it's a bit similar to the euro. We've retraced to close to up to this 38% level. So I would expect resistance at this 149.07 level right there. And although we're actually trading above the 200 period simple moving average, I might favor a breakout to the downside over a breakout to the upside. Okay, back to this inverse head and shoulders pattern. We looked at this last week. It's a bullish reversal pattern. Regular head and shoulders is a bearish reversal pattern. Here we have shoulder, head, shoulder. We have this well-defined neckline up here, and we see the price kind of consolidated up here. It hasn't been able to break through yet. We have a bullish crossover here with the 50 crossing above the 200. If price can hold above here, I would expect some follow through to the upside and probably close this gap here. Let's see what happens with CAD JPY. It's at an inflection point, and I think it could go either way there. Dollar yen, we got a death cross, the 50 crossing below the 200. Yochai pointed this one out to me. Just as that crossover happened, there was a nice down move, ushered in a nice down move. Look at this big red bearish candle that came in after this bearish crossover, the death cross, the 50 crossing below the 200. Okay. Last slide I want to show to you today is, or last chart rather, is the Australian dollar against the Japanese yen. Wanted to pull up a candlestick pattern. So let's look at what happened on this chart. We had a really nice uptrend here. Right at the top we had a doji. Doji is where price opened and where price closed were the same. So it just looks like a plus or a cross. It's actually kind of a long leg doji. Sometimes if there was a bit of space, if the open and the close weren't exactly the same, it would be called a spinning top. But in any case, what does the doji tell us? It tells us there's indecision, basically. So we had this very bullish move, up, 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 bullish candles, strength, confidence in the bulls, and then we get this doji, which is actually kind of a neutral pattern, but if you see it at the top of an uptrend like this, it reflects uncertainty, it reflects indecision, it reflects lack of confidence in the bulls. And what happened? Sure enough, price sold off the next bar. We also had a second confirmation in terms of getting short here. I'm always talking about stochastics and crossing above 20 or crossing below 80, and we got that bearish signal here. So we had two nice clues that price might reverse here in the Australian dollar against the Japanese yen. And with that, guys, I want to thank you all very much for joining me today. It's always a pleasure to speak to you. If you've got any questions, you can email them to webinar@octafx.com. And otherwise, I look forward to seeing you next week, and good trading. Bye for now.